Good afternoon, good morning, or aloha, depending on where you're viewing this webinar from. Welcome and thank you for joining us for Now What? How the New Federal Tax Law Impacts Charitable Nonprofits. My name is Rick Cohen. I'm with the National Council of Nonprofits, and I'd like to again welcome you to this special nationwide webinar today. This webinar is being recorded, so if you'd like to come back and review some points later on, just stay tuned. We'll be emailing you after this with a link to the recording as well as some additional resources we'll be talking about throughout the webinar. If you have any questions that you'd like to send in that we'll try to tackle during the Q&A later on, there's that link on the screen for you. It's www.councilofnonprofits.org/webinar question. Webinar question is all one word. Feel free to send in your questions anytime throughout the webinar. We'll try to cover as many as we can toward the end, but we do have several thousand registrants who are tuning in, so we probably will not be able to get to all the questions. You can also send questions via Twitter using the hashtag NowWhatNPS. We also invite you to share some of the learnings that you hear along the way with that hashtag. You'll also find that hashtag the bottom right-hand corner of your screen on every slide, as well as the National Council of Nonprofits Twitter handle. Now, without further ado, let me turn things over to our President and CEO, Tim Delaney.
Thanks, Rick. Welcome to everyone on this special webinar on behalf of the National Council of Nonprofits and our nationwide network of nonprofits. As this map shows, the National Council of Nonprofits connects nonprofits from coast to coast and border to border. By working with and through our member state associations of nonprofits and nonprofit allies across the country, the National Council of Nonprofits is the nation's largest network of nonprofits. The state associations of nonprofits connect the nonprofits in their states on a sector-wide basis, not just the arts, or education, or foundations, or human services, but all of them and more. They serve as capacity builders for nonprofits, conveners of the sector, advocates for sound public policies on which all 501c3 organizations rely, and more. And because they share that information across state lines, it leverages knowledge to protect and advance the work of all nonprofits. In addition, because so much public policy work is done at the state level, we're proud that many national organizations concerned about state public policy matters have joined us as state policy allies. Groups such as the Alliance of American Museums, Habitat for Humanity, United Way, and the Y, formerly known as the YMCA. So, the new federal tax law applies with equal force across the entire country. The map on your screen shows the major highways in the United States. When driving along those highways, you can see many things, but other parts are somewhat hidden along other roads and in nooks and crannies that have yet to be explored. The same is true with the new federal tax code. We can see some things now, but much more will be revealed and explored later. During the next hour, we will pause to look at some of the most visible parts of the 500-page bill, the topics identified on your screen now. But please remember that this is not a comprehensive tour of the United States or the new federal tax law. The bill wasn't introduced until 2 months ago and was a moving target up until it was passed 10 days before the end of the year. Said another way, the new law was signed into law less than 3 weeks ago. People will need more time to explore not just the nooks and crannies, but even some of the more visible parts. For this overview, I will underscore 3 important items. First, I want to thank the following groups that have made this webinar possible. Our national board. The week after the new federal tax law was signed into law, our board members met to consider how the new law could impact the work of charitable nonprofits. Their commitment to the sector helped design this webinar. Our network. Last week, we held national calls with state association leaders from your states to gather their ideas about the new federal tax law. As usual, they shared important insights from across the country to fit pieces of this new puzzle together to help build out this webinar. Our mission funding partners who provide us general operating support. We value the trust you place in us so we can be nimble in addressing emergent needs for the nonprofit community. We also encourage all funders right now as to the importance of the general operating support for your grantees during these uncertain times. Finally, to the thousands of you who are participating today from all 50 states, thank you for your commitment to advancing and protecting nonprofit missions. We appreciate that you registered for this webinar to learn what you can do to comply with this new law and the unfolding consequences. Please note that this webinar is not carved in stone. When the tax law bill has been signed into law, or while it has been signed into law, the IRS has provided very little guidance during the last 3 weeks. So the black letter of the statutes exist, but the gray areas of interpretation on how to implement the statutes have not been issued. That means much of what people are thinking right now is preliminary. Also, this webinar is not legal advice. It is not accounting advice. It is not designed for subsets of the 501c3 sector. Although the new federal tax law contains provisions of special interest to certain nonprofits, such as higher education, we are not addressing narrow subsets on this call. Our organization and our network focus on the commons. Think of it as the common defense of all 501c3 organizations. So what follows are common issues of concern for most 501c3 organizations, from the largest foundations in the world to the tiny yet vital nonprofits serving people in local communities. It does not include a list of the things proposed in the law that did not pass. We don't want to confuse you. We will have that on some of the materials that Rick alluded to earlier. Finally, it is not sugar-coated. We will call them like we see them. We see certain dangers ahead for the work of charitable nonprofits and foundations, and we believe that you are better served knowing what is coming so you can protect your organizations and missions. Finally, some basic math. To emphasize this last point about not sugarcoating and to provide a mental outline for what my colleagues will be sharing, please look at this basic and immutable math formula. Tax cuts. When most Americans see that we're getting some tax cuts, we yell, yippee! We think it's really nice and we're excited. Yet if we think things through, we recognize that tax cuts equal revenue cuts. Well, what does that mean if revenue gets cut? Well, revenue cuts lead to spending cuts. Spending cuts means that programs that we all rely upon, such as transportation, safe bridges, airports, things such as human services for individuals in need, and much, much more will get cut. And unfortunately, all those cuts do not end up in cuts in human needs. When governments cut taxes, cut revenue, and cut spending, they do not cut human needs. Human needs not only continue, but they also increase. They start going up as people have additional needs when their initial needs are not met. What's that mean? Well, it means that the nonprofit community as a whole needs to do more to take care of those human needs. And unfortunately, the nonprofit community, since the Great Recession first hit, have been on the receiving end of all these various cuts. And as human needs go up, the demand for our services has gone up, while the resources to provide them has not kept pace. It also means that foundations face higher demands as more nonprofits turn to foundations for assistance in meeting their basic needs. So that is the basic math that we're all looking at. Now, in a moment, my colleague Jenny Chandler is going to be presenting and sharing with you what the impact of the new federal law is on nonprofits as organizations and employers. Next, my colleague Amy Silver O'Leary, our Director of Resource Development, will share some insights on what needs to be done in this new fundraising environment. Please note that this is an area where we must speak the truth and not sugarcoat the challenges. Congress did not change the 100-year-old law allowing deductible charitable giving. But they made other changes to the law that have led other experts to predict that the nonprofit community will lose billions of dollars in contributions. Amy will focus her presentation on what nonprofits must do now internally. You can and must keep your eyes focused on the short term in terms of your fundraising. Yet we cannot, as a sector, ignore the external consequences of the new federal tax law. We must raise our voices as advocates to get Congress to change the law to permit all Americans to be recognized for supporting their local communities through a universal charitable deduction. This is not a mixed message, but it's a dual message of focusing internally and externally. Again, not sugarcoating things, my colleague David Thompson, our Vice President of Public Policy, will share insights on what needs to be done to prepare for the resulting policy dangers to the work of nonprofits. Then I will return to share some action steps that you might want to take to protect your nonprofits and be a champion for those that you serve. And then Rick Cohen, who you heard from earlier, our Director of Communications and Operations, will come back and share some of the questions that you all are asking, such as via that Twitter handle you see there, #NowWhatNPs, so that we can hear some questions from you and we can try to answer them in the limited time we will have. Rick will also share with you some of the resources that we will have posted on our website so that people can access those, as well as this webinar that is being recorded. They will all be available for free. So with that, let me turn things over to Jenny Chandler, our Vice President, who will share her insights on what the impact of the tax law is on organizations.
Thank you, Tim, and thanks to all of you listening. So we're going to dive right in. With changes in the tax brackets and the lower marginal tax rates, there will be an impact on payroll withholding, which impacts nonprofits as employers. And we have some breaking news. Literally 25 minutes ago, we got a hold of a copy of the early release withholding table guidance, IRS Notice 1036. The IRS literally just issued this a few hours ago. The notice provides an early release of the new withholding tables that will be published later this month. And here's what the notice says, quote, "Employers should implement the 2018 withholding tables as soon as possible, but no later than February 15, 2018. Continue to use the 2017 withholding tables until you implement the 2018 withholding tables." So there's the answer to one of the burning questions that nonprofits, among other employers, have been asking. However, while you're moving expeditiously to adjust your employees' withholdings, two cautions. First, this early release notice is not the official withholding tables for 2018, which the IRS says it will post later this month. And second, many nonprofits rely on professional payroll processing firms to prepare their employees' paychecks. And those companies have also been waiting for these tables, so they're going to need a bit of time to make their own adjustments. This is a process that employers want to be careful with. You don't want to under withhold because that could cause a tax liability for the nonprofit and the employees. So nonprofits want to withhold the right amount for your employees, and employees may want to update their W-4s. So you'll want to give them time to do that. And just know that when an employee submits a new W-4, the employer has up to 60 days to implement those changes. But remember that IRS notice today that says that employers need to get all this in place by February 15th. So there's going to be a little bit of a scramble to that deadline. We've included a link to this new IRS notice and the new tax rates and income brackets for 2018 in the resources that we'll be sharing after the webinar. And we've also posted many other articles and background of interest about the impact of the new tax law. So that'll be coming to you in a link right after the webinar. And then remember, also on the horizon, as you are adjusting adjusting withholdings, you have to think about the state and local income tax withholdings. 40 states follow some or all of the federal tax code, and then many other states may be reopening their own state tax codes for other reasons related to this new tax law. So be on the lookout for changes to state and local withholding amounts. And that's going to affect employees' paychecks. And it's going to take states a little longer than the IRS to adjust all these moving pieces. So we just want to keep this payroll withholding issue front and center, so that we withhold the correct amount from our employees' paychecks, and then also manage their expectations about the timing of all of this, because it will be a process. So how will the new tax law impact health insurance costs? Everyone anticipates that insurance premiums will be affected, mostly by going up. I'm sure you know that the penalty for individuals who choose not to purchase health insurance coverage, known as the individual mandate, doesn't go away until 2019, but we're already seeing predictions that premiums are likely to rise before then as a result of this expectation that fewer people will be covered. So higher premiums will, of course, make it more expensive for nonprofits to purchase health insurance for their employees. Some nonprofits are already seeing this happen with their premiums for 2018. So this is a budget planning issue for boards of directors, executive directors, finance directors, and really anyone involved in budgeting. You'll want to plan for rising health insurance costs unless your nonprofit is in a market where premiums are really not expected to be affected. And this is, of course, is a reminder also for grant makers. The cost of insurance for their own operations may go up, and for grant makers to be aware that the operating costs of their grantees may be affected by rising health insurance costs. So really, this is an issue for everyone. Less access to affordable health insurance impacts everyone. So looking ahead to fringe benefits, what's going to be different this year from last year that our employees are not used to? First of all, many personal deductions were eliminated in the new tax law, including those for work-related expenses that are not reimbursed by the employer. This means, let's say you're recruiting a new employee who's planning to move from Arizona to Oregon. Last year, she could deduct her moving expenses. In 2018, she won't be able to. So make sure to manage expectations about this and other formally deductible expenses. There's one personal work-related deduction that survived the chopping block that we were pleased to see, which was the deduction teachers can take when they buy school supplies. Teachers will still be able to deduct up to $250 on their personal tax return for classroom supplies that they purchase that are not reimbursed by their employer, whether or not they itemize. And then nonprofits may also want to consider how they will provide transportation benefits. These are payments a nonprofit may make to help employees with commuting and parking expenses. Because under the new law, if the nonprofit pays these transportation benefits directly on behalf of the employee, the nonprofit will actually be penalized and have to pay a tax at the corporate tax rate. So if this has been a fringe benefit your nonprofit has offered in the past, you may not want to do it that way. You can still provide transportation benefits and help employees out with their expenses to commute to work. And that's going to be through a pre-tax qualified plan that essentially reimburses the employee's expenses. And then the last fringe benefit we wanted to point out is a bit of an outlier, but that's why we wanted to mention it, just in case your nonprofit is prone to giving special recognition awards to employees. They're what the IRS calls achievement awards, maybe cash, gift cards, a special meal, tickets to an event, something that you really mean to provide that's nice for that employee to recognize and commend him or her for good performance. But under the old law, employees didn't have to recognize the value of those awards as income. Now, employees have to pay tax just as if the award were a taxable cash bonus. So this change is effective immediately, and this may feel like kind of a bummer since an employer may think of the award as a gift, which shouldn't be taxed, but the IRS considers achievement awards to be just like regular income. So those are some changes to fringe benefits. Next issue. There has long been a penalty on excessive and not reasonable compensation for nonprofit employees. Under the new tax law, the current rules around excessive compensation remain intact, and there's a new penalty on highly compensated employees. One way to look at this penalty is that it's not that important to your nonprofit, maybe because it only applies to really sky-high compensation, but we also see it as a stepping stone to potential future legislative or regulatory attempts to limit nonprofit compensation. The new tax law creates a new provision, Section 4950, that imposes a 21% excise tax for highly compensated employees, defined as the top 5 highest compensated employees. So this penalty is only on the portion of compensation that's in excess of $1 million. So it's not going to apply to it's really only going to apply to a small number of charitable organizations and foundations. Yet this new federal law could be, as I mentioned, a stepping stone for state legislatures to follow suit, such as by placing caps on nonprofit and foundation executive compensation, and doing so at rates much lower than the $1 million in this law. Indeed, it's already been tried in a few states, including Montana, in connection with much lower salaries than $1 million, unsuccessfully, we might add, because of the advocacy efforts of charitable nonprofits. So this issue could quickly pivot to focus on salaries that are lower than that $1 million. What about a salary level of $250,000 or $100,000 or even lower? That's why we're concerned about this and wanted to flag it for you. Our network is going to be watching this issue, and we consider it a serious warning sign that we all need to be at the table with policymakers, sharing our stories about the work we do, educating them about our own needs to attract and retain the best talent, and making the case for investing in that talent with those who invest in us, such as our foundation partners. We think the lesson here is advocate for your mission or else. And speaking of else, what else in the new tax law might impact the operations of your nonprofit? There's some other provisions that affect just some nonprofits' operations in special ways, and the time limitations here prevent us from providing all those details, but we want to flag just 3: refinancing for tax-exempt bonds, international investments, and then the new excise tax on net investment income of certain private colleges and universities that will only apply to very few of them. So this is worth noting because it also signals a willingness of Congress to realize tax revenue from tax-exempt organizations' investments. So that's something to think about. I hope the topics I've covered here have answered some of your questions, but we think there are 2 really big questions that people are asking in connection with the new tax law. Will it be harder to raise money in light of fewer people itemizing deductions? And what challenges are ahead for those served by our nonprofit? So for board members, are you helping your nonprofit be prepared by thinking about these questions in particular? And for grant makers, what new challenges will your grantees face? During the rest of the program, my colleagues will be addressing these questions, but first, I just need to mention one more operational issue, and that is unrelated business income tax and the tax on unrelated business income. If your nonprofit engages in unrelated business activities, you know who you are. It's nothing to be ashamed of. It's something that we want to pay attention to now a little bit more, because in 2018, the new tax law changes how nonprofits will report unrelated business income and losses, and how they can utilize net operating losses in connection with it. The outstanding question that we cannot answer today is how to document where your nonprofit's income or losses from unrelated business activities are coming from. We recommend that until the IRS issues guidance on this new rule, you're pretty careful about tracking and documenting the types of activities, the quote, lines of business, as the IRS call them, where your nonprofit's income or losses are coming from. So you'll be in a strong position to complete that IRS Form 990T accurately. We're definitely all waiting to be informed, and while we're waiting for the IRS to issue guidance, we want you to be prepared to report for that unrelated business income in 2018. So this is just another stay tuned for IRS guidance situation. And then just so you know, the flat tax for corporate rates is the UBI tax as well. And then I don't want to end on a downer. I want to end on a celebration, because if your nonprofit is paying unrelated business income taxation, you are earning money. And this is a perfect introduction to my colleague, Amy Silver O'Leary, the Director of Resource Development here at the National Council of Nonprofits, who has a much more fun role than I do in this program, because she'll be sharing insights about how the new tax law will impact fundraising. Amy.
Thank you, Jenny, and hello, everyone. So most people know by now that while the charitable deduction was preserved in the new federal tax law, going forward, many fewer people are expected to itemize. So instead of 30% of taxpayers itemizing, it may be about 5%. Research indicated that donations could go down by around $20 billion a year, as Tim mentioned, due to the doubling of the standard deduction and the estate tax exclusion. Many fundraisers are concerned about this projection, and we are too. But that's all the sort of 30,000-foot view of the donor landscape. At 30,000 feet, you can see the horizon, the mountain ranges, and the cloud cover. If you fly down to, say, 5,000 feet and focus on your more specific territory, it's a different picture. At 5,000 feet, you can base your strategy on your particular terrain. In this case, not the whole public policy landscape for charitable nonprofits, which is what we worry about here at the National Council of Nonprofits, but your specific organization. What is your long-term plan for financial sustainability? Can your revenue be further diversified? What is your contingency plan if a revenue stream dries up, or if the economic environment changes radically? No one yet knows how this tax law will impact local and state government budgets, but the prediction is that there will be more budget cuts impacting charitable nonprofits, making resource development, which includes but isn't limited to fundraising, more important than ever. So now's a good time to buckle down on basics and best practices. So you may want to get your executive director and board together if you haven't already done this. And in addition to planning for potentially increased health insurance costs, as Jenny mentioned, make sure you have contingency plans. Make sure you have some cash reserves or a plan to grow some, and that everyone, board and staff, is focused on your nonprofit's financial future. Now let's talk about 3 feet. If you're a fundraiser or an executive director, there's not much in the fundraising department that you have to worry about in 2018 that you didn't already have to worry about before. Why? Because what works in the long term is to focus on powerfully communicating your organization's impact and developing strong, authentic relationships with donors of all sorts. At 3 feet, the tax deduction is a bit of a red herring. Sure, it nudges some people to make a giving decision at the end of December, but that's a tactical issue that you can adjust for as you plan your year-round and end-of-year campaigns. We don't necessarily know which of our donors itemize now, right? You may have seen the research that found that people who are most likely to leave a bequest are not the biggest donors. They're the ones who give most regularly. So stewardship of the donor who sends you $10 a month can be as important as stewardship of major donors. We've all heard the stories about unexpected bequests. So while fundraising can vary enormously from one organization to another, I can safely say that everyone should be thoughtfully stewarding our donors. Everyone should have a plan and work the plan. Everyone's executive director, board, and development director, if you have one, need to be coordinating closely. And we see no reason not to have ambitious goals for 2018 and beyond. I'm a donor, an average donor from an ordinary household, and I'm probably not going to itemize next year. But I'm not planning to reduce my giving. In fact, when someone comes to me with a compelling ask, I'll probably increase my giving, just like I did in the past. And I bet for a lot of you, it's the same. So focus on your development plan and on articulating your impact, not on tax deductions. We don't have time today to go into a lot of detail about every single provision of the law that might affect fundraising. But I do want to mention that under the new law, donors will still need a receipt in order to deduct any single donation of $250 or more. And of course, we all want to thank and recognize all of our donors as quickly, as often, and as meaningfully as we can. Another thing to keep in mind is that donor-advised funds, which have been growing by leaps and bounds, will probably accelerate even more now. And of course, donations out of donor-advised funds are not driven by a tax year calendar. Now, if your organization doesn't have a fundraising plan, or if you could improve your donor stewardship practices, or if you're an executive director and you're expecting the development director to do it all, or if your board isn't engaged in it, then yes, now is a good time to get all that in place. And you should definitely join your state association of nonprofits and help advocate for the sector, because that's how nonprofits protect the positive policy environment that helps us advance our missions. Do that this afternoon. But on Monday morning, make sure you have an annual fundraising plan. We have lots of good resources on our main fundraising page that's pictured here. We don't get into this fundraising system or approach is good, that one is less good, but we do point to places where you can learn more, including the Association of Fundraising Professionals, the Foundation Center, state associations of nonprofits, and other resources. I will say this, every system will work if you work it, and none of them will work if you don't work it. So have a plan, work the plan, and improve it a little every year. With that, I'd like to introduce my colleague, David Thompson, our Vice President of Public Policy, and ask, David, in addition to donors and funders, who else do nonprofits need to be talking to every day to advance their missions?
Anyone who supports the mission itself and anyone who has a public policy perspective that could help nonprofits get their work done. Hi, I'm David Thompson, Vice President of Public Policy. Our perspective now is public policy implications of the federal tax law. Congress passed the tax law. Thousands of you are on this call because you know something big happened. There was a seismic shift. The earth moved. First biggest change in tax law in 31 years. So what does that mean? Well, we know that the results will be waves upon waves of changes hitting the states in the coming weeks, months, and years. As I will discuss, not all of those changes are going to be bad. And we have opportunities as we're dealing with the changes. But changes are definitely coming, and we will want to highlight, what we want to do is highlight some of those that you need to be watching out for and preparing to get engaged in. Our starting point of analysis is the reality that the federal tax law will cost somewhere between $1 trillion and $3.2 trillion over the next 10 years. As was said earlier, tax cuts equal revenue cuts equal spending cuts. So what does that mean to charitable nonprofits? Now that the law is done, there's every reason to believe that most debates in Congress are going to focus on the need to reduce the deficit, something the tax bill greatly deepens. The tax law isn't paid for, and the deficit hawks stayed quiet during most of that debate. We've already seen some renewed calls from some in Congress to start reducing spending on social programs for the sake of the deficit. Even bipartisan programs like the Children's Health Insurance Program is likely to be shortchanged or underfunded because of the deficit. The actions Congress takes to reduce the deficit will undoubtedly have direct effects on states and charitable nonprofits. Consider these two graphics. This first chart shows the flow of resources from the federal government down through the state and local governments to charitable nonprofits. Federal revenues make up, on average, 31% of state revenues. When the federal government cuts revenues, that means cuts to the state level and on down the line. As everyone on this call undoubtedly knows, governments at all levels, state, federal, and local, depend on charitable nonprofits to provide services. Charitable nonprofits earn 32.5%, nearly a third of their revenue from governments at all levels. As we know, those aren't handouts. These are all payments for services rendered pursuant to written agreements between governments and nonprofits. When governments shut down programs, they don't reduce human need, as was said earlier. Frontline charitable nonprofits can get left holding the bag, filling the gaps when governments walk away. And foundations frequently are turned to fill in the gaps that the governments change. Even before federal spending cuts start coming, making their way or not making their way to the states, states are already in a precarious position. The graphic there, just so you know, is to show that each state is different in its own space. The colors don't have any significant meaning. 49 states must balance their budgets. It's a significant and serious requirement. There's litigation in Pennsylvania right now because the balanced budgeting that they did earlier this year may not have been done right. Fiscal years usually run from July 1st to June 30th. If a state runs out of money now, it has to start cutting before June 30th in order to make adjustments and balance its budget. This year, 22 states passed balanced budget amendment or passed balanced budgets by their statutory deadline of July 1st, only to have to reopen them later because revenues didn't come in as expected. This is a serious and ongoing challenge for each individual state. Connecticut this year is perhaps the best worst case scenario of what happens when revenues come in short and government and policymakers don't get their act together. The governor was forced to make drastic cuts, across the board cuts or targeted cuts to numerous programs, including many social programs performed by charitable nonprofits. The Connecticut Alliance, our colleague organization in the state association in Connecticut, was very active and had a seat at the table in the spending negotiations. And at the end of the day, most of those cuts were reprogrammed, were changed, were reduced, so that the vulnerable populations were not injured as much or were not injured because of the spending cuts. That's an evidence, it's a case of aggressive advocacy on behalf of the people we serve. A few years back in Louisiana, new governor inherited a budget deficit that had to be balanced in a couple of months. The lawmakers rapidly came up with ways to raise revenue, and among other things, imposing new taxes on charitable nonprofits overnight. Organizations had to go from zero to full compliance virtually overnight in a couple of weeks and start generating the revenue to help fund the budget hole. Fortunately, those new taxes were ultimately repealed, again through advocacy, but it does show the case that when states, I mentioned Connecticut and Louisiana, but when your states experience budget gaps, lawmakers have to make quick decisions, and quite often they come to and they target charitable nonprofits. Also, I share these two examples because many states, perhaps yours already, are on shaky fiscal ground. Kentucky has a budget deficit of $1 billion right now. New York's deficit is $4 billion after having surpluses for several years. We all know of Illinois' ongoing budget crisis. It's legendary. While New Mexico and North Dakota are mired in at least their third straight year of spending cuts. Iowa has cuts heading up to $100 million or needing to make cuts. Oklahoma doesn't even have a budget for the fiscal year that started way back July 1st. So the actions of those states take, whether and how they turn to charitable nonprofits to balance their state budgets, are early warning signs for your states. Ways to tax or cut nonprofits is a way of balancing their budget, and that's to set the stage of things are shaky already, and nonprofits frequently are targeted. So back to the tax bill. What does this mean? Pressure to cut spending, where we know that the deficit hawks are getting louder, and Congress is vowing to reduce spending, to turn off or to tighten the spigot. The federal government's likely to reduce the amount of money it sends to the states. As states backfill lost revenues, they're likely to make cuts. In recent years, many of you know this already, that has meant reducing spending on education, failing to pay to fully fund employee pension plans, which is now haunting many states, cutting spending on social programs, cutting or changing spending on health programs. And as they make shifts in state budgets, What's that doing to the revenue resources for many of the programs that many of you are involved in? Money is fungible, and as one funding stream dries up, states make shifts, and quite often charitable nonprofits are the recipients of the negative end of those. States have also been considering ways to cut costs by changing eligibility criteria, as in lowering the income level for being able to receive health care or other benefits. A good question your boards can be asking is, how will reduced coverage affect the people you serve? Another way politicians attempt to reduce program costs is imposing community service mandates on program beneficiaries. Just this morning, the administration announced that it will start approving state Medicaid waivers that include work requirements. They go on to include a community engagement component that likely means people will get credit for volunteering at charitable nonprofits. The presumption is that charities always want volunteers, and the politicians think they're doing us a favor. We all know volunteers aren't free. It's a new burden or mandate, possibly an opportunity, but more likely a burden on charitable nonprofits. It's an issue that typically nonprofits aren't asked what we think, and it's one that is probably going to be accelerating because of the announcement today of the waivers issue. Another way states address or adjust to spending cuts is to reduce revenue sharing to municipal governments. Often that causes local policymakers to turn to nonprofits for cash. Here's an example from Maine from a few years ago that got national attention, meaning legislators everywhere were paying attention. The governor wanted to reduce revenue sharing to local governments by about $200 million per year. He proposed and almost got enacted a change in the state's property tax law that would have allowed local governments to impose property taxes on some charitable nonprofits. To the governor, this was intended as a nifty policy change to let him provide tax cuts elsewhere. To nonprofits, it was an outrageous violation of the social compact between charitable nonprofits and their communities. The bill didn't pass, but lawmakers everywhere remember it as a nifty idea that we all need to be worrying about. The tax implications could be severe because of the federal tax law. This is another wave that we can all expect to see coming. This is how the federal tax law affects state tax policy. Every time state laws are rewritten, whenever a state reopens its tax code, it creates winners and losers. We anticipate attempts will be made to reconfigure state and local tax laws in ways that provide new tax cuts, lead to new levies on tax-exempt entities. And when you open up your tax code just a little, when you crack the door just a smidge, every brilliant idea, every bad idea, and every half-baked idea comes rushing in to try to slip through the crack. That's what we all need to be on guard for and engaged in. The federal tax law doubles the standard deduction. Well, doubling the standard deduction affects charitable giving, as we were discussing earlier, but it also reduces state revenue for the dozen states that automatically follow federal tax law. The loss of revenue comes because taxpayers will be deducting more from their taxable income and taking fewer itemized deductions. What's the state? How will the state change their tax code to restore that revenue lost? And will other bright ideas hitch a ride? Personal exemptions were repealed in the federal tax law, and 8 states automatically followed the federal personal exemption, but those don't exist anymore. So those states will actually see increased revenue, or stated another way, taxpayers in those states like Colorado and Maryland and Michigan will see tax hikes. They'll be paying higher state tax laws because of the repeal of the personal exemption. The governor of Michigan's already said this week that he's going to be pushing legislation to restore and gradually increase Michigan's personal exemptions, because he says the federal tax law increases taxes on Michiganders by $1.5 billion a year. So there's the need to change the desire, the governor's already stated, to change the tax law. Well, this is an opportunity. The wave coming across Michigan and coming across other states is the tax codes being reopened. But here's an opportunity. In 2011, Michigan repealed 3 tax credits that benefited the work of charitable nonprofits in order to pay for a corporate tax break or tax cuts. They repealed the 3 credits at a cost of $50 billion in donations to the work of charitable nonprofits. The Council of Michigan Foundation estimated that the cost was $50 million per year. What if, when the legislature in Michigan reopens their law, they restore those tax credits? Maybe they can do it a little bit better. Could your state's charitable giving incentives be improved? And maybe if you don't have a giving incentive in your state, maybe there's time to create something new. State and local taxes, SALT, is another issue that's gotten a great deal of information, a great deal of attention. The tax law limits itemized deductions for state and local income and property taxes to $10,000. This will significantly reduce tax deductions for individual taxpayers in so-called high tax states like California, Connecticut, New Jersey, New York. That means a tax hike on taxpayers in those states. It also means pressure will likely build to reduce taxes, reduce spending in those states as well. New York Governor Cuomo has already announced in his State of the State address last week that he's going to be exploring significant shift in tax policy, maybe creating a payroll tax system so that employers will be paying the taxes instead of individuals because of the impact on individual taxpayers. A bill was introduced in California last week that gets around the limit on state and local tax deduction or payments by permitting, if enacted, would permit charitable contributions to the California Excellence Fund in lieu of paying state taxes. The governor-elect of New Jersey is thinking about doing the same thing, allowing individuals to make their property tax payments to a charity connected to the government. So the government gets the funds, and then the individuals get the full charitable deduction, assuming they itemize, they get the full charitable deduction as opposed to being limited to $10,000. Lots of questions about whether these donations to, quote, a government charity, close quote, is a good idea. And we're curious, how do people feel? We look forward to hearing more from folks. Is this a legal approach? What does it do to the image of real and frontline charitable nonprofits doing great work every day? These are some recurring questions. The law also taxes, the federal tax law creates ways of taxing tax exempts, as Jenny Chandler mentioned. Time is running short, so I'll just briefly mention endowments. The federal tax law taxes the endowment income of some universities. Well, states have been trying this for years. Connecticut and Massachusetts in particular have been seeking to tax endowments. Montana, a few years back, actually looked to tax assets of foundations. Salaries, taxing the salary of nonprofits is not new. The federal tax law shows legislators how, one way of doing it, but we've seen other states, again, Montana, Vermont has a bill limiting the reimbursement of salaries. And then on the question of UBIT, unrelated business income, is the whole issue of what is business, what's competing with for-profit businesses. Legislators don't have raised questions over the years in this area. So there's the federal tax law, we believe, will create an incentive for changing the tax laws. Very briefly, at the city level, City Hall, the funds flow or they don't flow down to City Hall. And when local governments run out of money, they quite often turn to or turn on their charitable nonprofit partners, nonprofits that are doing vital work in the community and praised when the government has funds and has a balanced budget. All of a sudden, the politicians start saying we're not paying our fair share. We know we're doing good work. But state, local governments have sought to impose business taxes on nonprofits or special assessments. Chicago has a water usage fee, or there's sewage fees being imposed on nonprofits, frequently outside the scope of law. And then there are payments in lieu of taxes. That's what PILOT stands for. This is something that started in Boston, has been spreading across the country, and we're seeing it pop up all over the country because the local governments are looking for money. They're not getting revenue sharing from the states. They are seeing shrinking federal resources, so they're turning to, and I'd say in many cases, on their partners in the communities. State associations of nonprofits are very engaged on all of these issues, As you see things, please let them know. As they tell you of things, please take action. I'm going to close and turn it back to Tim Delaney by just reminding of the flow of what happens at the federal level affects all the other levels, and nonprofits are right there at the bottom on the receiving end. Tim.
Super. Thank you, David. What I want to do now is turn to some ideas on how you can be a champion for your nonprofit. The best way to be a champion, I believe, is to remember that it's not about you. It's not even about your nonprofit. It's about the people and your local communities that you're serving. And with that in mind, as the state tax codes are going to be reopened, whether for good or for bad, in the next few months, recognize that those state tax codes will be in place for the next 10, 15, 20 years. So if you are silent now, if you do not engage now, you're actually cooking things into the system so that charitable nonprofits will be hurt for the next decade or two. So please get involved. Because of the magnitude of this new law change and the resulting changes at the state and local levels, we recommend that you hold a special board meeting. And we identify 3 potential topics there: compliance, sustainability, and advocacy and public policy. We're not telling you what to do. We're simply suggesting some things that you might want to consider. If, however, in the evaluations that you will be receiving later, you want to have some recommended ideas on what nonprofit boards can do, we will develop a draft agenda if that would be useful. In the meantime, here are some ideas that you might want to consider. For compliance and beyond it, again, this is the first federal tax overhaul in 30 years. We believe it's important enough for you to call timeout to consider how it will affect your organization and its mission. The board should invite senior staff to come in and talk about what's going to be going on in the future at the federal and the state and the local levels. Consider where you can find reliable and timely information. Do you need to be restructuring? Are there any other new considerations? Grant makers, please ask, what new needs will our grantees have? Do they need to have investments in capacity building, in their public policy work? The second big thing to consider is sustainability. And I think Amy set it up perfectly. Have a plan, work the plan. So make sure that you have a strong plan. The third thing to consider is how to prepare for the policy dangers ahead. Again, as David stressed, there may be opportunities as well as just threats, but all states will be doing these things. It may be that they appear in different order and in different intensity in different states, but all will be reopening their tax codes, adjusting state spending, making the federal government will be making spending cuts, and there will be local changes to taxes and spending. And just like the math formula, those will be occurring. The end result is that governments will be offloading more of their work onto the backs of nonprofits and expecting grant makers to fill the financial gap created by the governments. Finally, I want to leave you with this wonderful resource. Many years ago, we got together with 4 other national groups that collaborated with BoardSource, which is the nationally recognized leader for board governance. We collectively created this program, Stand for Your Mission, and BoardSource has done a terrific job of continuing to promote it. Every nonprofit board needs to recognize that there is a new expectation of board advocacy. It isn't just an add-on. It isn't something that you might do sometime. There is an expectation that all board members will get engaged in advocacy. And the advocacy doesn't have to be just in front of government. It can also be with the local media. It can be with other people who would fund you. It can be with a variety of different people. But you need to be advocating every day. In fact, we recommend that every day you wake up, you ask, who can I advocate our mission for today? And so think who you can be visiting with to advance your nonprofit's mission. With that, I want to throw it back to Rick, who will help us with a couple of questions. Rick?
Great. Thank you, Tim, and thank you, Jenny, Amy, and David. As many of you online may see, we have over 4,000 folks who are joining us in this webinar, and so we don't anticipate being able to get through the flurry of questions that you all have sent in, but I do want to tee up a few here for the team. I'm going to start off with one for Amy. Amy, we've received a couple of questions where you referred in your part of the presentation to how donor-advised funds might increase in popularity. I was wondering, and our viewers are wondering, if you could elaborate just a little bit on that.
Sure, Rick. So there are a number of reasons why we expect to see donor-advised funds grow even more, but two of the reasons that are top of my mind are that, one, there's a lot of vastly appreciated stock out there, and for a lot of donors, it's just more convenient to give that appreciated stock directly to a donor-advised fund and then sort of parcel it out to all the different nonprofits that they support. Another reason is that it's kind of technical, but some people are talking about what's called bunching, where you give one large donation in 1 year to a donor-advised fund, and that takes you over the limit where you can now begin to itemize. And then maybe for the next year or two, you parcel out your contributions out of your donor-advised fund. So I don't know how much people are actually going to be doing that, but there's some talk out there about it. So those are two of the reasons.
Great, thank you, Amy. Now we've got the next question here for Jenny. Jenny went over a little bit on unrelated business income tax and unrelated business income, and we had a few questions from the field asking if we could share a few examples of what is unrelated business.
Okay, I will, Rick, but I really want to encourage everyone to just go to irs.gov and then go to the charities page and then just use their search field for unrelated business income, and or go to the resource page that we're going to provide you a link to. And we also have a page on our website that describes unrelated business income. This is tax advice, and to Tim's point, we can't give you tax advice, but I'll give you an example. So advertising income, National Council of Nonprofits, we have a newsletter that goes out on a regular basis, and we sell space for advertisers. We're not an advertising company. Advertising is something that we do to earn income. And we may use that income to support our mission, but that's not the point. The point is the way that we earn the income through advertising. There are exceptions, lots of exceptions that nonprofits can take advantage of, so that the activities you engage in that seem to be commercial in nature actually fit one of the exceptions, so that you don't have to pay tax. But that is really beyond the scope of this program. So I just want to let you know that there's tons of good information on our website if you just search for unrelated business income.
Great. Thank you, Jenny. And it looks like we've got another question directed to you. Let's see, we've got a number of nonprofits talking about how they have remote employees, and they want to know if the home office deduction has been preserved.
Okay, so this is an area where I'm going to have to say I can't give you personally legal advice or tax advice, because if you're working at home, then you've got to work that out for your own taxes. But our understanding is that most personal deductions were wiped out by the tax law. So if you're a nonprofit that has a lot of remote employees and they're working at home and they're relying on taking a slice of their the square footage of their home and taking a nice deduction for the business use of that home office, that may not be available to them. So that's something you want to think about as you're thinking about retaining and attracting remote workers, and figuring out what you're going to do to make it perhaps more affordable for them to remain on your team.
Thank you, Jenny. And looks like we have time for just one more question. And while Tim noted at the top of the webinar that we won't be talking a lot about what was not included in the bill, we received several questions from nonprofits who have been monitoring various provisions that popped up in different versions, whether the House or Senate bill, and we're just looking for a quick update on them. Among those are the volunteer mileage rate, and looks like we've got a few questions here about the Johnson Amendment as well. David, can you give us a quick hit on what happened with those provisions?
I'll do as humanly possible for something of great passion. Short answer is the resources page we're going to be linking to will have information about what's in, what was not in. We did a special edition of our newsletter in December that laid these out as well. Volunteer mileage is not in. Private activity bonds was not included. Johnson Amendment was not included. The Johnson Amendment is the longstanding law that protects nonprofit nonpartisanship. There was an effort to politicize charitable nonprofits, houses of worship, foundations, to politicize so they could endorse and oppose candidates and things like that. Vast majority of the nonprofit community rose up in opposition to that provision. It did not make it into the tax bill. That's the good news. The bad news is it will very likely come back in the next week or two, or within the next month. So it's something we all need to be very engaged on. And a link for special information on this subject is givevoice.org. Givevoice.org for more on the issue of nonpartisanship and why it's so important. Thank you, Rick.
Great. Thank you, David. And before we turn things back to Tim to conclude, I do want to touch on those resources that have been alluded to a few times throughout the webinar. First, the resources that we were referencing, as well as many others, are posted on our website at councilofnonprofits.org/how Tax Cuts Jobs Act impacts nonprofits. Don't worry, you don't have to write all that down right now. You'll receive that link in the follow-up email you'll receive after the webinar, and we'll be adding resources to that as they become available, including the recording of today's webinar. We again want to encourage you to stay connected through your state association of nonprofits. Much of what you heard today was focused on the federal level, but it did reference that there's a lot that's going to be happening at the state and local levels. Be sure that you are connected with your state association so that you can receive the latest information and so you can engage in advocacy to make sure that nonprofits in your state remain protected. You can also remain connected with us via our social media. You see the two handles there on the screen, NATL Council NPS and Build NP Capacity. We'll be sharing updates via those as well. And we also have our free e-newsletters, Nonprofit Advocacy Matters, which goes out every other Monday, Nonprofit Knowledge Matters, which goes out once per month. We would love for you to join on, subscribe. They're free, and we'll be sharing more information as things change and things come clear. And with that, let me turn things back over to Tim to conclude.
Great. Thank you, Rick. And while I'm thanking Rick, let me also thank my colleagues here. They gave up part of their holidays. They have invested a lot of time and energy trying to get ahead on this. And as I mentioned earlier, we've been aided significantly by our national board and our network of nonprofit leaders across the country who made this particular presentation possible. So thank you to my teammates. Thank you to our network. Thank you to our board. The tax bill in all its permutations is actually quite complex, but how we respond is actually not as complex. It's not rocket science. In fact, we can turn to a famous children's book, Swimmy, about Swimmy the fish, which is really a story about the power of collaboration and working together. Briefly told, the story involves an individual fish and many fish, in fact, who were swimming in 360 directions, having fun, swimming around. And lo and behold, they started being eaten by larger fish. And those who were not consumed then went to hide. And they found that their life was pretty miserable by themselves. And they didn't quite know what to do or how to respond. Ultimately, the smaller fish organized and they came together to swim in formation so that they could scare the larger fish away. The moral of the story here is that nonprofits need to do the same. We can be eaten when state tax codes are reopened. We can be eaten when local tax codes are reopened. We can be eaten through a lot of negative things, or we can come together through our state associations of nonprofits to have a much stronger voice and not only a stronger voice, but we can be protected by having more eyes and more ears out there looking at what's happening on the horizon. Are there big fish coming at us? If so, then we can come up with a response. But if we don't hear it or see it, then we have problems. And so please work together with your state association of nonprofits so that you can be swimming in formation and be safe. The final slide I'll leave you with is together we can. That's really the motto that we live by around here, is together we can, together we must. And indeed, it's sort of built on the age-old notion that the Three Musketeers pledged. All for one for all, united we stand, divided we fall. Folks, we need to come together. And when we do, we can get it done. Thank you all very much for your participation in this webinar today. As you've heard multiple times, we'll be sharing the link to the webinar. It will be available for free along with other resources to help you serve the people in your local communities. Let's go get them. Thank you very much.